In today's video, I'm going to help you understand how long we may be in this bear market and what you can do as an investor to make the most of it. Hey everyone, I'm James Knoll, founder of Root Financial, and I'm here to teach you how to get the most out of life with your money. Now, as of this recording, the S&P 500 is down about 23%. The Dow Jones is down about 21%. The NASDAQ is down about 33%. It's been a challenging year for investors. Now, a bear market is technically defined as a pullback in the market of 20% or more. So these are the three core US markets, and all of them are in bear market territory. The question for us as investors is, how long will this last? When will things recover? And what can we do with our investments to make the most of it? That's exactly what we're going to go over in today's video. So the reality is, in any bear market, we never know exactly when it will end. We do have the benefit of hindsight, though, to get some perspective and see how long have these things lasted in the past. What we're looking at here, this is a chart from Ben Carlson's A Wealth of Common Sense, which is a wonderful blog, and this is pulling data and charts right from this blog post. What you can see here is this is showing you every single bear market since the end of World War II. It's not including the current one, but it's showing everything from the end of World War II up until today. Now what you can see here is this is measuring two things. Number one, how long did it take for the US market to drop 20%, so technically enter that bear market territory? And then number two, how long did it take to go from down 20% to hit its bottom? And of course, you never knew when the bottom was in the moment, but with the benefit of hindsight, we absolutely know. So what you can see here is everything from the bear market of 1946 all the way to the bear market of 2020 when COVID happened and shutdowns and the whole world went on pause. This is a list of all of those declines. So what we see is there's absolutely no consistency. There's not a formula here for once you hit 20%, then you'll hit the bottom at any set point or any set interval after that. You have everything from a couple of these bear markets in 1948 and 1957, where a single day after the market was down 20%, it dropped one more day and then it recovered. Then you have other time periods like 2000 to 2002, where the market went down 20% and it took 353 days to do so. So it was dropping for almost an entire year, and then took over a year and a half after that point to finally hit its bottom. So what we can see here is it takes varying amounts of time for the market to drop 20%, and then other varying amounts of time to go from down 20% to its final bottom. But what we see is on average, it takes about 236 days for the market to go from its peak to hit 20% down, so technically enter bear market territory, call this 2/3 of a year or so, and then it takes another 131 days on average to go from 20% down to the bottom. So if we're gonna look at this and try to infer anything from it, again, this is just averages and this can skew greatly, but it takes the longest time on average to go down 20% and then about half the time, again, on average, I'm gonna continue to reiterate that, to go from down 20% to the actual bottom. So as we're looking at this, are we at the bottom today? Who knows? We'll never truly know until we have the benefit of hindsight, until we have the recovery, but this gives us some basic perspective of how long does it take for the market to hit bear market territory, and then how long does it take to bottom. So that's just some basic information of, as this thing is going down, historically speaking, how long might we expect this to happen? If we want to know what's really important, though, it's not just how long does it take to go down 20% and then how long does it take to hit the bottom, it's how long does it take to break even? How long is it going to take for this market to recover? Well, with this chart, again from the same blog post from Ben Carlson at A Wealth of Common Sense, what we see here is this is showing from the peak to the trough to break even, how long did that last? So the peak means the market's all-time high before it then went into bear market territory. The trough is the absolute bottom of that, and then break even is getting back to those levels of all-time high. So as we look at this chart, we see the same thing that we saw before, which is there's a wide variety of different types of bear markets. We saw one a couple years ago in 2020, where as you can see here, it only took 1 month, technically 5 weeks, from the market to go from its top to its bottom, where it lost about 35% of its value. From there, it only took 6 months, which in the grand scheme of things is a very short period of time, to fully recoup all those losses and then continue hitting all-time highs. So the total downturn, the total bear market until we hit break even again during 2020, it was only 7 months, which is a very short period of time, all things considered, for a bear market. Now, if we look at one like 2000 to 2002, this was a much longer one. you can see it took 31 months for the market to hit its bottom. To go from all-time high to trough, it took about 2.5 years. And then it took about 4 years to hit its all-time high again. So 4 years to break even after that point. So as we're looking at this, we see some of these are relatively short, some of these are very long, but on average, it takes about 12 months from the market to go from all-time highs to its bottom. As of this recording, we're about 10 months into this current bear market. And then it takes, on average, 21 months to recover and hit those new all-time highs again. So all in this cycle, it's about 2.5+ years for market to go from top to bottom to recover again. So that's some basic data. That's some basic perspective on how do these things work? How long does it take to drop down? How long does it take to fully recover? This provides us some perspective as investors as we're in the midst of this current bear market. The next question is, what are we supposed to do with our investments from here on out? Seeing how hard things are, seeing the downturn of 20, 25, 30+%, do we stop investing? Do we temporarily get out of the market? Do we wait for the bottom to happen? Well, let's check out that next. Now, before we jump into the actual data, I would love to know from you. Comment below, where do you see the market heading next? Do you see things recovering from here and maybe we're at the bottom? Do you think that maybe we have a long way to go until the market hits the bottom? I would love to hear from you, because what I hear from a lot of people as I'm doing these videos or talking to clients or talking to just people that like to talk about the market is there's this sense that, oh, things aren't going to recover anytime soon. There's a sense of, oh, we can't project forward-looking returns for a little while because the market's down in the dumps. Well, I'd like to flip that a little bit, because if we take a big step back and we look at this, if you ask people, would you rather buy when the market is high or buy when the market is low? What would you rather do? Well, logically, we'd say I'd rather buy when the market's low as opposed to when the market's high. But when given the opportunity, like right now, oftentimes we switch that. We look at it and we say, oh my gosh, well, with the market where it is, or the economy where it is, or inflation where it is, or the Fed doing what it's doing, why on earth would we invest right now? Well, this is the thing about investing. The market doesn't just go lower for no reason. It goes lower because of fear of what's going to happen next. So oftentimes those best times to invest are when we least feel like doing so. And if we want to put a price on the market, about a year ago, when the market was closer to its all-time highs, the price to earnings ratio on the S&P 500 is about 24, which means for every dollar of earnings that the S&P 500 on average is generating, you are paying about $24 for that $1 of earnings. Today, the price to earnings ratio is closer to 15, meaning the price of these companies has come way down, even, as a side note, as the earnings of those companies on average has grown throughout the first part of 2022. The price that you can purchase for them has come down. So when you look at it, things are cheaper today. You can buy things at a discount today, but it's because of concerns about where the world is going and what's going to happen to the economy based on a number of different factors. So with that in mind, let's actually look at data. Let's look at after the market's dropped 10% or 20% or 30% on average, where does it tend to go from there over the next 1 year, 3 year, or 5 years? And again, this is just average, and average doesn't mean a whole lot because it can be a lot more or a lot less, as we saw in previous slides. But if we look at this information from dimensional funds here, what this shows what does the market do after a 10% decline versus what does the market do after a 20% decline, and then what does the market do after a 30% decline. Well, if we look at this, let's focus on this number right here. Again, the S&P 500, the Dow Jones, they're down between 22 and 25% as of this recording. Well, on average, over the next 1 year, as we can see in this blue bar here, the market tends to grow by over 22%. Some years much higher, some years much lower, but on average, that's a pretty strong 1 year return. Over the next 3 years, the market tends to grow by 41%. Now this is cumulative, it's not 41% per year, but 41% total growth over the following 3 years. And over the following 5 years, it tends to grow by about 72%. So as you look at it, after the market's dropped like it has, the average returns you can expect on average, and I keep saying that, is actually higher than what you could expect from the market as a whole, which is about 10% per year, just looking at the S&P 500 historically. So what are we to do as investors? Well, number one, understand how long these typical bear markets last, understand how long might it take to recover, but also understand that in the midst of this, this is the absolute best time on average, historically speaking, to be an investor. And it makes sense rationally, because rationally we know it's better to buy something at a low price than it is to buy something at a high price. Emotionally, it's very difficult for a lot of us to do that. We look at what's going around the world, we look at inflation and interest rates and recession concerns. Keep in mind this. What do you know about where the world is headed that's not already reflected in the stock prices of the investments we can purchase? Yes, the market's down. Yes, things are not looking great in the stock market, but it's not because of how companies' earnings are today. As I mentioned, earnings are actually up so far through the first 10 months of this year. It's because of those forward-looking expectations. So as you look at it, keep in mind that this can be the best time to buy if you have a good investment strategy in place, if you have a good financial plan in place, and if you're doing things the right way. So in summary, what can you do as an investor? Well, there's plenty of opportunities here to do the normal things like rebalancing and tax loss harvesting, maybe even implementing some tax strategies like accelerating Roth conversions or moving assets out of your estate if that's part of your overall financial plan, doing so when asset values are lower. But in general, do those things. Number two, make sure you have a good investment strategy in place. If your investment strategy is picking 1 or 2 or 3 stocks and hoping for the best, we've seen plenty of stocks whose 80-90% or more of their value, and many of them will likely never recover. So if your investment strategy is based on speculation and trying to pick the next hot stock, you very easily could get burned in a time like this. But if your investment strategy is solid and you have a diversified portfolio that's owning the right types of investments that fit your unique plan, this could be a great time to continue buying, or at least not sell, because we know that the market will recover. We just don't know when that time exactly is going to be. But we do know that the key to building long-term wealth is to maintain that discipline, maintain that focus, maintain that patience, even though the rest of the world seems like it's going crazy. Continuing the course even through the ups and downs is the absolute best way to build long-term wealth for yourself and your family. Now, if you're watching this and you want to know more information about how do I construct that right portfolio for my retirement goals, well, be sure to check out this playlist above where I go over just that. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.